In March 2026, the Strait of Hormuz, the single most important energy choke point on Earth, went dark. Not a single warship fired on a cargo vessel, not a single sea mine detonated in the shipping lanes, and not a single naval blockade order crossed a military commander's desk. What shut it down were 7 cancellation letters, mailed from insurance offices in London. 80% of everything the world trades by volume moves on the ocean, and half of that trade's total value rides on the same ships. Even under normal conditions, an estimated $192 billion of commerce gets disrupted annually at maritime choke points. When those choke points become active war zones, the losses multiply exponentially, and the mechanism that decides whether cargo moves or stays anchored is not military power. It is a piece of paper called an insurance policy. What follows is how that system operates, how it broke apart in 72 hours, and why the fallout is still compounding. Every commercial ship crossing international waters carries stacked layers of financial protection. Hull and machinery coverage ensures the physical vessel itself. Cargo insurance covers whatever is loaded on board, and protection and indemnity coverage, known as P&I, handles crew injuries, pollution liability, and wreck removal. Sitting above all of those layers is specialized war risk insurance, a standalone product designed to cover damage from armed conflict, anti-ship missiles, naval mines, and drone strikes. Here is the catch. Standard marine policies carve out an explicit exclusion for war, piracy, and terrorism, which means any ship owner sailing into contested waters needs a separate war risk policy, or they are completely exposed. London's Joint War Committee designates geographic zones called listed areas, where conflict risk runs high, and any vessel entering one of those zones triggers a negotiation for an additional war risk premium, usually quoted as a percentage of the ship's hull value for a 7-day window. Under calm conditions, those premiums barely register, historically sitting around 0.125 to 0.25% of hull value. The vulnerability hiding inside that system is straightforward. War risk underwriting depends entirely on reliable intelligence about missile capabilities, drone targeting patterns, and what belligerents actually intend to do next. When a conflict escalates faster than the models can adjust, the math stops working. Actuaries cannot price what they cannot predict, and when that happens, they do the only rational thing available to them, which is pull out entirely. That pattern has repeated across every major maritime conflict of the last century. Between 1980 and 1988, during the Iran-Iraq tanker war, 411 ships came under attack in the Persian Gulf, 239 of them petroleum tankers. War risk premiums rocketed from a baseline of roughly 0.5% to somewhere between 10 and 20% of cargo value, which made commercial transit financially impossible. London stepped in first, activating the War Risks Act of 1952 and backstopping 95% of the reinsurance for British-registered merchant ships, and Washington followed by triggering its Title 12 War Risk Insurance Program. Those two state-backed programs are what kept Middle Eastern crude flowing to global refineries during 8 years of active combat. A similar collapse played out after September 11th, when commercial insurers slashed coverage for vessels operating anywhere near the Arabian Peninsula, and the U.S. President authorized Title 12 specifically for hull war risk policies that the private market had abandoned. 2 decades later, after Russia invaded Ukraine in February 2022, global reinsurers imposed blanket exclusions on the entire Black Sea region. Swiss Re absorbed a $283 million loss in the first quarter alone, and by January 2023, 12 of the 13 major ship insurers had canceled war risk coverage for Ukraine entirely. What came next in Ukraine turned into a case study in financial engineering under fire. Kyiv partnered with broker Marsh McLennan and Lloyd's of London to build the Unity facility, which offered up to $50 million per vessel in hull and P&I war risk coverage, and cut the going commercial rate roughly in half, to approximately 0.75%. The architecture that made it work was a first loss compensation fund underwritten by Ukrainian state banks Ukreximbank and Ukregasbank, with confirmation from Germany's DZ Bank. By March 2024, Unity had expanded beyond grain to cover all non-military cargo, proving that sovereign financial guarantees paired with private underwriting expertise can grow from an emergency patch into a durable trade corridor. None of that, however, prepared anyone for the speed of what happened in March 2026. 21 miles, that is the width of the Strait of Hormuz at its narrowest point, with shipping lanes only 2 miles wide in each direction. On an ordinary day, 138 commercial vessels pass through, carrying approximately 20 to 21 million barrels of crude oil and petroleum products, roughly 20% of global consumption, along with over 11 billion cubic feet of liquefied natural gas from Qatar and between 20 and 30% of the world's fertilizer exports originating from Qatar, Saudi Arabia, and Oman. To appreciate the scale of exposure sitting in that corridor, consider the fleet. Early 2025 data put the global commercial fleet at approximately 112,500 vessels, with a combined capacity of 2.44 billion deadweight tons. Bulk carriers account for 42.5% of that capacity, and oil tankers another 27.5%. A single very large crude carrier hauls between 1.9 and 2.2 million barrels of crude per voyage, and carries a hull valuation of $200 to $300 million, while LNG carriers run between $200 and $250 million each. On any given day, tens of billions of dollars in hull value and cargo pass through the Strait of Hormuz, and every dollar of it depends on an active insurance policy. On February 28, 2026, joint military strikes by the United States and Israel hit Iranian nuclear facilities and killed Supreme Leader Ali Khamenei. Iran retaliated with massive missile and drone barrages across the region, and the Islamic Revolutionary Guard Corps broadcast warnings prohibiting commercial vessel passage through the strait. What happened next had nothing to do with navies. No armada sealed the waterway, and no minefield blocked the shipping lanes. The closure came through the insurance market. Within 48 hours of the first strikes, London Treaty reinsurers, operating under Solvency II capital requirements that demand reserves against a 99.5% value at risk scenario, pulled their capacity from the entire region. At midnight Greenwich Mean Time on March 5, 2026, 7 of the 12 international Group P&I clubs, Guard, North Standard, Skuld, Steamship Mutual, the American Club, the Swedish Club, and the London P&I Club, sent identical cancellation notices to every ship owner in their portfolio. Collectively, those 7 clubs cover roughly 90% of the world's ocean-going tonnage. 7 letters. That is what it took to shut down the most critical energy corridor on the planet. Ship owners received a 72-hour window to complete transits already underway, or face sailing without any coverage at all. Without insurance, banks refuse to issue the letters of credit that finance cargo purchases, port authorities block entry, and charterers will not book space on an uninsured hull. The chain reaction is absolute: trade stops. For the handful of underwriters still willing to quote a breach premium on individual voyages, rates spiked from the pre-conflict baseline of 0.125% to between 1 and 3% of hull value. On a $200 to $300 million VLCC, a 3% rate translates to a $7.5 million charge for a single transit, which obliterates the freight profit in one line item. The severity lurking behind those numbers made the pricing rational. A direct hit from an anti-ship ballistic missile triggers uncontrollable onboard fires, identified by Allianz Global Corporate and Specialty as the most expensive category of marine claim by value. If a fully laden supertanker goes down in an ecologically sensitive waterway, the environmental cleanup and third-party liability costs can exceed the hull's replacement value by orders of magnitude. Traffic through the strait collapsed. From 138 daily crossings, the number fell by 90%. Between 150 and 300 oil and LNG tankers dropped anchor in the Gulf of Oman, with nowhere to go, and an estimated 1,000 commercial vessels, representing $25 billion in total hull value, sat trapped inside the Persian Gulf. Brent crude vaulted from $72 to $80 per barrel in the first 48 hours, and eventually touched $126. Iraq was forced to curtail approximately 1.5 million barrels per day of production, because onshore storage filled up, and Qatar halted LNG production entirely because there was no way to ship it out. Federal Reserve Bank of Dallas modeling showed that $100 per barrel crude would drive a 1.3 percentage point spike in U.S. headline inflation, and that was just energy. The damage to food markets hit harder. Shipping costs for bulk agricultural commodities are additive, not multiplicative, which means a $50 per ton increase in freight and insurance takes a huge bite out of cheap wheat, but barely registers on high-value electronics. Freight costs represent an average of 11% of the landed price for grains and oilseeds, but that share swings wildly between 2 and 43%, depending on distance and fleet availability. What makes this devastating for human populations is that demand for staple calories barely bends. A 1% increase in cereal prices only reduces consumption by 0.61% in low-income countries, and 0.43% in wealthy ones. People do not stop eating bread because the price climbs. Instead, they cut spending on healthcare, education, and higher nutrition foods to cover the gap. Indonesia, the world's largest palm oil producer, felt the hit immediately. The country had exported approximately $20.2 billion worth of palm oil in the year before the crisis, and as war risk premiums spiked, logistics and insurance costs for Indonesian exporters climbed by roughly 50%. Fertilizer markets moved in lockstep, with Middle East urea prices surging 19% in a single week to over $590 per metric ton. When fertilizer costs spike, farmers around the world plant less or cut application rates, which degrades the next harvest cycle's yields. An insurance shock hitting fertilizer shipments in March 2026 was already baked into reduced food supplies for 2027. Across 46 countries studied over a 30-year window, the IMF determined that a doubling of maritime freight and insurance rates reliably pushes domestic inflation up by approximately 0.7 percentage points. Global consumer prices climb an average of 1.5% from shipping cost spikes alone. But in small island developing states, the increase reaches 7.5%, and in least developed countries, it lands at 2.2%. Those are nations importing on thin, infrequent shipping schedules, with no ability to negotiate bulk freight discounts, and no retail capital buffer to absorb the price shock. Washington's response came on March 3rd, when the Trump administration announced that the U.S. Development Finance Corporation would deploy a $20 billion reinsurance facility at near pre-conflict rates of approximately 0.2%, effectively setting a synthetic market cap that private insurers could not ignore. The problem was execution. The DFC had spent its existence as a development bank financing fixed, onshore projects in lower-income countries. Underwriting hull and cargo insurance for a globally flagged commercial fleet was something it had never attempted. Private Lloyd's syndicates carry centuries of institutional knowledge in maritime claims adjustment, and the DFC simply did not have that infrastructure. Shipowners who accepted the DFC's coverage also signed on to mandatory U.S. Navy escort coordination and strict adherence to designated transit corridors, with any deviation capable of voiding the policy entirely. By March 10th, a full week after the announcement, tracking data showed only a negligible number of vessels had risked the transit. Across the Pacific, Asian economies mobilized their own defenses. Japan depends on the Middle East for over 90% of its crude oil, and Tokyo authorized an emergency drawdown of 45 days from combined reserves that could sustain the country for approximately 254 days of normal consumption, while METI rolled out direct subsidies capping the national average gasoline price at 170 yen per liter. South Korea, holding reserves sufficient for 208 days of consumption, activated Crisis Level 3 protocol for the first time in 3 decades, subsidizing elevated freight costs for tankers forced to reroute around the Cape of Good Hope and imposing domestic fuel price caps. Indonesia's situation ran deeper. With a GDP of approximately $1.39 trillion, the world's largest archipelagic nation is bound to maritime trade at every level. Palm oil exports alone generate $20.2 billion annually, while the country imports $15.1 billion in refined petroleum and $7.15 billion in crude. Jakarta maintains tight fiscal discipline, keeping its debt-to-GDP ratio between 38.8% and 40.46%, against a statutory ceiling of 60%. But two VLCs, owned by PT Pertamina International Shipping, the Pertamina Pride and the Gamsonoro, became stranded inside the Gulf the moment the P&I clubs withdrew war risk coverage. Jakarta opened urgent diplomatic channels directly with Iranian authorities to negotiate safe passage for its state-owned assets. What this crisis exposed is that the architecture of a sovereign backstop determines whether it works or fails. Tanker War, the UK War Risks Fund, maintained British flag transit despite 411 vessel attacks in the region. Claims flowed through subrogation, and the fund sustained itself on salvage receipts, with zero net drain on Parliament. Ukraine's Unity facility scaled from grain-only coverage to all non-military cargo, stabilized premiums at 0.75%, and kept sovereign liabilities strictly capped. The DFC's $20 billion facility calmed the initial market panic, but friction in execution delayed the actual resumption of physical trade for weeks. It also exposed the U.S. Treasury to concentrated catastrophic liabilities while displacing the natural pricing mechanisms that private underwriters depend on. The terrorism reinsurance programs built after September 11th illustrate the difference that disciplined design makes. America's TRIA program engineered a gradual shift of exposure back to private insurers through escalating deductibles. The UK's Pool Re functions as a mutual reinsurer, backed by an uncapped HM Treasury guarantee, spanning £2.2 trillion in commercial assets, and has migrated to advanced portfolio-based pricing. France's Gary 8 program blocks adverse selection by mandating participation for any large risk above €20 million. What separates all three from the DFC facility is built-in discipline, with mandatory private sector skin in the game, risk-based pricing, and the deliberate crowding in of private capital through catastrophe bonds. The Florida Hurricane Catastrophe Fund offers the cautionary tale of what happens without that discipline. By deliberately not charging actuarially sound premiums, the fund suppressed insurance costs in highly exposed coastal zones and created severe moral hazard. It now faces a potential liquidity shortfall of $8 billion, against a maximum statutory liability of $17 billion. This crisis clarified something that defense strategists and finance ministers had theorized about, but never witnessed at this scale. The instantaneous withdrawal of war risk capacity by 7 P&I clubs, driven by European reinsurers bound by Solvency II capital constraints, accomplished in 72 hours what traditional naval blockades historically needed months or years to achieve. The actuarial mechanism itself has become the weapon. Japan and South Korea demonstrated that when international maritime finance collapses, enormous domestic fiscal containment through strategic petroleum reserves and aggressive retail price caps is the only lever left. Indonesia's struggle to free its stranded Pertamina tankers revealed a gap that most emerging maritime nations share: the absence of sovereign war risk frameworks designed for mobile assets at sea rather than fixed infrastructure on land. Jakarta is already moving to close that gap. Danantara, Indonesia's newly established sovereign wealth fund, is consolidating 15 state-owned insurance entities into just 3 specialized firms, including the major general insurer, Asuransi Jasindo. The deepest vulnerability in modern global energy and food infrastructure turns out to be neither physical nor kinetic. It is entirely financial. 7 cancellation letters accomplished what generations of military planners spent decades trying to achieve. And the next time those letters go out, the world may be even less prepared to absorb the shock.